So this week temperatures are going to prove key in driving prices. At the moment they've been revised warmer, which is expecting to dampen demand later this week. On top of that, we're also seeing a return in supply in France. So there's obviously been a series of nuclear outages over the last few weeks, and at the moment we're expecting as much as 3.5 gigawatts of capacity to come back online throughout this week, which would potentially see our export demand to France reduce in terms of power. In terms of gas, there's still a lot of uncertainty with regards to Rough, so it has come back and we are able to withdraw at the moment, but in terms of consistent volumes going forward, there is still some uncertainty which might cause some volatility over the short term. Finally, because we're approaching Christmas this week, there's a risk that liquidity is going to dry up. The amount of active traders in the market significantly reduces, which means you often get quite a wide bid-offer spread, and as a result of that, trading starts to thin. So there's a risk that we could see kind of wide spread in prices, but actually very little trading might happen. So if we look over the short term, supply-demand fundamentals are looking to improve this week. As I've mentioned, we've got a reduced expectation to export power to France. On top of that, we're also seeing a resurgent wind generation forecast, with forecasts as high as kind of 7.5 gigawatts later this week. And what that should do is act to widen supply margins and potentially drive day-ahead prices lower over the next week or so. In terms of seasonal prices, they have started to trend higher over the last week or so. So over the last couple of months we have seen a bit of a downside move for power, but they have bounced off a medium-term trend line and at the moment are trading higher again. At the moment they've reached a consolidation area that we reached kind of a week ago, where prices started to trade sideways, and that's likely to provide some resistance to the upside over the short term. So in terms of fixed price contracts, the recommendation is going to be to hold over the coming weeks unless you're ready to pull the trigger ASAP. The reason the recommendation is to hold is that we're expecting liquidity to dry up and the bid-offer spread is going to go quite wide. So if you do go to market during these next couple of weeks, you're likely to secure a much higher than market value price based on the fact that the buyer and the seller aren't as narrow as you'd expect them to be. In terms of flexible contracts, it's down to attitude to risk. As we know, Q1 holds a lot of risk with regards to Rough storage, with regards to potential nuclear outages in France. So the recommendation is to make sure you've got a reasonable hedge in place for Q1 at least. Looking further out at the front season and beyond, the market is still trending higher. So again, make sure your hedge positions reflect the rising market that we're currently in. Finally, from everyone at Inenco, I want to wish you a Merry Christmas and a Happy New Year, and I hope you'll watch again next year.